Hello, Sage Seed. Look at this disclaimer for me. Basically, I'm trying to educate you into a financial sage, not give you specific stock advice. Today I have for us the latest annual report of Meta Platforms. Big tech, smarter than any other consumer services company, young CEO. Oh wow, I should have bought it in 2021 when the price dipped. Let's dive in so that our wisdom can blossom. The balance sheet. Cash on hand shooting straight upwards. The total assets have swelled. Lots of money coming in. This has not changed the total assets to total liability ratio, mainly because Meta took out almost $9 billion in additional long-term debt last year, taking full advantage of that absolutely gilded reputation. This company had a total assets to liability ratio of 3, maybe even slightly higher, and now it still has that. Did you need to take out $9 billion when you had a very defensive balance sheet to begin with? Income statement. Revenue definitely looking a lot more tame and doing the typical oscillation that we've seen of a lot of large cap companies. A lot of large cap companies had a bit of a decline, now followed up with a little bit of a resurgence. The only slight extension of costs was entirely made up of research and development pretty much. And it was fairly reasonable growth, given that it was accompanied with additional revenue this year. Overall, though, the business still looking a bit young in terms of not having the ability to wind up or down. What I mean is that the revenue is very much going right through you like a bowl of Taco Bell chili. Meta has not been able to mature in the ways that you typically see of businesses of this size. Therefore, earnings per share will be at almost 14 and fall down to 863 and then rise back up to 1519. There's nothing wrong with having volatile earnings. In fact, it's very much a part of the culture of tech companies when they're small. Meta would be an extreme outlier in terms of the size of the company still behaving this way. But hey, they're no Palantir. Cash flow statement. We have ratcheting up of depreciation, organizational impairment charges, taking out billions and billions in new debt, and a very squishy expenses section on the income statement. I want to look into how can they justify acting this way? Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. One helpful thing to remember for this annual report is that there's 2 reportable segments that they break down for us, the family of apps and the reality labs. You may have heard that Facebook changed its name to Meta. Well, that's also the exact same thing as them creating the second segment, Reality Labs. That's all their metaverse stuff, the item 7. The CEO telling us, our mission is to give people the power to build community and bring the world closer together. So if you think Meta, formerly Facebook, is overreaching with any of this, you just didn't read the mission statement. Sorry. Now, it is much easier to surprise the world and all of your investors with this when your real business, your family of apps as you now call it, has had its ad impressions, main source of revenue, increase by pretty healthy double digits. And what I imagine the CEO office thought was a sign of strength. Income from operations was 46, almost 47 billion in a single year. I'm not trying to say anything controversial. They said it themselves. Family of apps is not Reality Labs. There's 2 segments now, not one. So by definition, they cannot be the priority anymore. And that really is the key point, is that once you're making tens of billions of dollars of operating income, it's definitely unusual to call that priority number 2 now. Investors who are worried about this are just asking, why are you not spinning this off? Well, here's a breakdown of how the 2 segments come together. We're still well within the first page of the item 7. Reality Labs is getting close to a quarter of all costs and expenses, despite representing basically less than 1% or maybe slightly more than 1% of revenue. Reality Labs is very expensive. Why would the management show us this table painted like this, really highlighting this point? They know that any investor is wondering, why are you not making this 2 separate businesses, aka spin-off? The simple answer, if you choose to accept it, Reality Labs would never exist as a standalone business. There is no venture capitalist in their right mind, any founders that would make a business that spends 30 plus billion in order to make barely almost 4 billion. One good news is that Meta has had its effective tax rate decreased. Yay! And laid off 22% of its staff in a single year. Huge grain of salt. It's very difficult to say that there's one thing to blame when it comes to something like a big layoff. But pull up the stats for all the other tech companies. All of them have been laying off, unfortunately. 22% of all headcount is on the high range of layoffs, though, and that's the point I'm trying to make here. Meta likely would have laid off no matter what this year, but would Meta have been very much on the high range of the relative amount of layoffs if it didn't have this little income sink attached to the real business? Slow down, slow down. Trust. Trust. Because Mark Zuckerberg isn't still one of the youngest CEOs in the United States. No. He's the CEO that's continued to build on the discipline and habits developed in 2022. While it's true that Zuckerberg has this unique experience of having been CEO of a pretty successful company in his younger years, this is a man who arguably would not understand what a usual experience of a decade in career means. Very tough to call you, especially it depends on the technology, it depends on the economy, of course. But all things held equal, most of us know not to tell our bosses, hey, I'm gonna ignore the thing that you hired me to do. Check out this cool thing. No, trust. You don't need me to pay attention to the old thing. This new thing will pay off in a decade. Leadership of this company, unfortunately, is as much a weakness as it is an asset. Continuing to scroll down, share repurchases, woo! Just like last week, we had the Apple video. And in fact, it's a common thing with a lot of the biggest companies in the American market right now. A lot of cash. And they're at that point in the business cycle, which does happen over and over again. The textbooks say they should just pay out dividends and return the money to investors so investors can find better uses of those monies. But every time this happens, you would be shocked at how rarely the large successful companies ever want to actually return oodles of money back to shareholders. Not only do you have to find a company that's going to make money more than is expected, but you got to trust that the management will actually return the money. Well, as much as I've teased Mr. Mark Zuckerberg, over 50 billion in share repurchases over essentially just a couple years' times does buy you a lot of leeway when it comes to staying a worthwhile company to invest in. And they're doubling up. They're going to add another 50 billion in the new season coming up 2024. As well as, I'm going to the next section now, the first ever cash dividend program. There will now be constant dividends. And so, pretty straightforward season for Meta. It's being led by a very astute board of directors into doing what the textbooks say, shooting money out. After reading through this, it's actually quite clear. It's in Meta, which had a total assets to liabilities of 3, so very defensive balance sheet, took out another loan when it really had the money to pay for it itself, is that Zuckerberg's only allowed to do his little reality labs thing if he doesn't even use the money on the balance sheet. Another win for the adults in the room. Unfortunately, there's only so much that responsible business practices can do to protect the workforce of a large conglomerate business. I mean, there's all sorts of reasons that factor into something like a 22% headcount reduction. Fundamentally, it is all tied into the company-wide return on investment, which is made a lot more difficult, as it's a lot less of a healthy looking picture when you have any segment losing money. The argument for spinning the two businesses off still exists, but not very likely to happen, because as we saw, no way Reality Labs is ever going to run as its own business. I remember the first time I logged onto Facebook. Actually, no, I don't remember that at all, weirdly. First post? No? My first poke, I remember that. Mr. Zuckerberg has done a lot, and he has experience. Possibly experience that no one else can really get. Probably most impressive is that years ago he realized that he would never have the perspective of the vast majority of people, because his career is unlike almost anyone's. Therefore, when he says, let me invest for a decade out, that is warped in ways that pretty much none of us will ever understand except him. And so he is surrounded by lots of very successful, very experienced business people all over his board of directors, all over his executive suite. He's not being crazy with this reality labs. I know I maybe made it sound like that at some points. He's comfortable doing that because he has such an incredible team around him. And so he's gonna get to live that life, the life of a wannabe Iron Man. Now, Sage Seeds AI is going to give us a valuation ranking. And the question is, does this rate high or low? Now, there's a huge positive and a huge negative in my mind, but in a strange kind of unique situation, I actually think this is so large, such an economy of scale, plus the nature of this tension between CEO and the rest of this executive suite is quite healthy from what I can tell. I'm gonna guess that it all balances out. This is in the top 50%, but maybe close to 50, maybe below 30 percentile, above 50th. But what do you think? The Sage Seeds AI is going to give us a valuation ranking. Sage Seeds AI is trained to identify value investment opportunities. Take a guess, tell your friends about it. Whichever one of you is closer to the actual Sage Seeds AI prediction is clearly destined to become a financial sage. Meta Platforms ranked in the 53rd percentile. Again, I technically am wrong. While I do hope they take a good hard look at that 22% number once more, it really is kind of high for a layoff, guys. Their actions don't seem to be of any terrifying consequence, at least not yet. Best of luck to them, best of luck to current or former Meta employees, and best of luck to all of you that watched until the end. If Meta stays this boring, maybe we skip it in future seasons, but who knows, things do tend to change in the economy. So stick around and I'll see you in the future.